couple of things going on. Of course, the big concern right now is whether or not the Fed's going to cut rates at the next meeting. Of course, right now, from what we're seeing on kind of most of the front is that we are seeing economic data slow down enough, at least from some of the off-the-run indicators, that we're very likely going to see another rate cut by the end of the year. There's really nothing kind of stopping the Fed from cutting rates by the end of the year, at least at this point. Of course, the big question becomes, again, you're cutting rates into a period of time where expectations are high that we're going to see an economic recovery next year. In other words, the economy is going to start gaining strength. This is the expectations. I'm not saying this is a true fact. I'm just saying the expectations are we're going to see an economic resurgence next year, primarily due to all of the build out of AI infrastructure next year. That's going to be a very large multiplier impact. And there's a lot of people running around right now going, oh my, these companies are spending all this money on AI. And that's true, they are. But it's going to create a lot of economic activity, about $5 trillion worth of spending over the next 4 to 5 years. That has about a 3 to 4 to 1 multiplier. So you're talking about a $15 to $20 trillion impact on a $25 trillion economy. So again, that's going to have a major impact on what happens in the rest of the economy and also help drive a lot of what happens in the markets, because all that money is going to get spent by the people that are receiving those funds from the build out. So all the infrastructure goes to the construction workers, et cetera. They spend money in the economy. That creates more revenue, more economic activity, so forth and so on. There's going to be a lot of stuff that's going on as we move into next year. And the question is, you're cutting rates and loosening financial conditions in that environment. So you potentially run the risk of causing an overheating in the economy, a pickup in inflation, those type of things. Again, rising inflation in an environment where you have stronger economic growth is not a problem. You should expect higher inflation. If you have robust economic growth, 3-4% economic growth, you should expect 3 to 4% inflation. Those two go together. And that's not a bad thing, because wages will come up. That's going to happen as well. And again, even the White House is now seeking to raise wages for hourly workers. So we're starting to see a push, right, for higher wages. But again, it's just a very interesting situation that we've got the Fed on this path to cut rates, and the markets are expecting a much stronger economic output next year. So again, how this eventually works out is going to be interesting, because normally the Fed's cutting rates when the economy is really, really weakening, and they're cutting rates to try to restart economic activity, or at least buoy economic activity, but that's not happening this time. So again, this also kind of brings us up to the point of recently the Fed just also announced the reduction of QT to zero. That's going to end at this month. It's not like they said we're going to stop QT in a couple of months or the end of the year. It's like, no, we're going to end QT at the end of the month. So what's the rush?
Catch me daily on The Real Investment Show. The link is in the description.